Someone looking at the data from an outside, it'd be like, well, they can formulate a story and saying this is a growth cycle and it's going to continue for 10 years or 5 years or whatever that looks like, right? So, sometimes, when you don't investigate, you don't know what the story behind that is. You can't just relate to, just the data on its own. While the data is really, really powerful, it's also important to understand the trends on a long-term basis rather than just that, short window of opportunity.
You're listening to Help Me Buy Property podcast powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs. From evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing.
Today's podcast is very, very interesting because I have someone who I'm a big fan of personally. I've seen, this person, or, he's been a person of influence for me in the real estate data space, since 2014, been in the data space for a decade. The founder of Microburbs focuses on using machine learning, quantifying, livability scores for the first time. I've never seen someone, do that ever before. And the comprehensive insights about neighborhoods and, housing commissions and all of that. So a great veteran in the data space, Mr. Luke Metcalfe. Luke, how are you today?
I'm very well, thank you, Moxin. Thank you very much for having me.
Yes, and thank you for coming on the show. I think we are going to have so much fun today talking about data, and it's a piece of interest. It's like a common, I call it a hobby, of course, a profession for you. But it's amazing, how real estate data has evolved and, what has happened in this space. But what I want to do is basically start off with your journey with Microburbs. Share a bit about that. You've been in media. There's a lot of light there. Microburbs is still, doing amazing stuff, but it does not take the right attention in the radar. So let the viewers and listeners understand, what is Microburbs about and how did it came into existence and, where is it heading towards?
Yeah, sure. So I've been a data geek and a programmer since I was 5. I'd always been fascinated by how data affects the real world and what special analysis could be done. Built and sold a couple of data businesses before Microburbs, but Moving forward to 2014, my wife and I were looking for a property, and I thought this was like the ultimate place to be doing analysis on data. So there's all of these websites you can go to, and there's all of this talk around, but no place where you can go to and actually get like a full summary of all the things about a property, particularly at that point from a livability point of view. So I love the idea of a geek like me quantifying coolness. So Microburbs is quite famous in the beginning for having these heat maps that can represent a HIP score down to a block level. And you can see even like the bad side of the tracks versus the good side of the tracks. And people go, hey, wow, that really is a heat map of trendiness. And then doing that for all kinds of different markets. So family score being about like how well behaved are children, how well do they do at school, are there amenities and other families around, convenience score. So the original idea was for all the different, I isolated 8 different dimensions of quality for a home, and each of them gets a score, and then you get the key stats behind it. So originally it was very much a livability site. Then I started to find actually these livability metrics can actually predict something really important, which is capital growth. And there was a lot of demand. Obviously, your investors are prepared to spend a bit more money for a service than a home buyer. And so we pivoted towards the investor, and it became this real search for the holy grail of capital growth. So we're in the business of collecting data from everywhere that we can find. So anything that's out there, some file that's up very briefly on the web that has really great data in it. We grab it, put it onto Microburbs. So this like full picture view of real estate, not just, the classic things that everyone talks about, but like what's coming left of center. What are things that people don't expect predict capital growth? What are the complicated interactions between it? And another thing is like, okay, let's just get every single listing. So we've got pretty much all the listings going back to 1990. So we're not relying on median prices from CoreLogic or anything. So we can do our own analysis. We can look at when someone buys a property and then sells it, we can work out how much capital growth they had, and then go down to that property level of like, okay, what are the drivers of an individual property's capital growth?
Yeah.
So yeah, broadly speaking, I think in real estate, like in anything, if you're going to succeed, you need to be passionate about it. And what really drives me is the fact that we can collect data on all kinds of things and then see, okay, how does it affect capital growth? How does it affect rental yield? How does it affect the value of an individual property? So we can do all of those with this data and then report back to the regular person, look, we've done the analysis across all the markets. So the whole country since 1990 or from whenever we could get the data from. The real estate data goes back to 1990, but like government data tends to start about 2005. And it's like, how resilient, to what degree can we rely on this consistently over time? So there's this mission of like finding what are the laws of real estate investing as opposed to, what's trendy now and what are people talking about right now? And
if we try to understand and break it down, what are the 8 key criteria, when we're talking about the future growth price perspective?
Yeah. So the biggest, one really big one is mean reversion. So the biggest gains are to be found from identifying suburbs and towns that have not moved with the rest of their relevant market. That relevant market thing is not a simple matter of just like, okay, the containing region.
Yeah.
But in real estate, people have a herd mentality. They go in waves. The average suburb doesn't have that many transactions in a given month or a given year. So you have all of this mispricing goes on. So you can have suburbs that are really way too high, overvalued, and way undervalued. And the machine is particularly good at being objective. The AI is particularly good at being objective and going, I think this is really the true price and it's going to fall back to that. So that's your mean reversion. Now, associated with mean reversion is momentum. So there are trends. So a suburb takes off and it may continue for a period of time. So the mean reversion, if you think about it, a graph that's like the curve returning back to where it has been. And then the momentum is it going in the same direction. So momentum is important, but often investors overstate it. They think it happens over longer periods than it actually does. And so if someone says that growth over the last 10 years is good, I want to see that, that usually means that it's headed for a correction. Another point to make is that markets are getting faster now. Time is speeding up. So
I think this growth cycles are shortening. That's what I really realized, right? Like I've been investing since 2006 and 7 as an avid investor, right? And I've never seen the market responding this fast, and the growth cycles shrunk down to almost like 2.5, 3 year cycles,
That's right.
Versus like 6 to 8 year cycle. So
that's right. Yeah. So in the 90s and the 2000s, you can have these 5, 7 year market cycles and it's getting crunched down. The same dynamics still work. So, but yeah, in our algorithms, like the algorithms get aware of like, okay, what is the speed of markets lately? So if you can't train directly a model on 1990 on today, because it will just assume that things are moving slower than they actually do.
Yes. It's a very interesting point that you make, because I was talking about this, just recently with a client as well, that like a lot of old school mentality when it comes to property from a long-term buy and hold, that's not really relevant today's time, because the way the market moves and the market cycles that change quite drastically, right? So when you talk about momentum, I think momentum plays a really, really important part from a velocity perspective as well, that, when the markets are coming down fast, the markets are growing back fast as well. And so that muscle memory of, markets moving is quite like for an average investor, it's quite volatile because by the time because there is so much paralysis analysis with a normal investor, right? If they think about buying, they'll take 6 months, 8 months analysis paralysis. And the market moves so fast, some of these in these smaller denominations, that they've actually like missed half the cycle. And so by the time they're entering into the market, they might be already in a mature market already in certain cases. So it's very interesting as to how the markets have moved these days.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
That's particularly a problem if they are going online and reading about what's trendy and what people are touting. So those kinds of markets that everyone's talking about buyer's agents are pushing people into them. You can very quickly have an undersupply of stock and increased expectations on the behalf of sellers. And you can have this very rapid correction going on. So yes, things are speeding up. The world is speeding up. Part of it is also just that people are using data more. So the world just was slower back in the 1990s. It took longer for messages to get out there. There were slower, you have media plans that would come over years. And the world is more complex with much more interactions, and that is reflected in market cycle lengths.
And how much of this growth comes back to the original fundamentals of property as well? So we are talking about market sentiments typically, right? It's like a lot of self-conscious bias where people are playing towards this, or like you hear a lot of influencers doing this, right? And I haven't tested these numbers out, but I always feel that there is some sort of correlation here where you have a 30 or a 50 or 100,000 people following you, and you have a course that you're selling, and you go out there and make a comment about, hey, blah is the suburb that is going to change or is going to grow. And then even like 5% of your followership basically goes in and invest in that suburbs. You can basically move the mean in those areas, right? Because all you need is like a good 50 or 100 sales in a particular month to move the mean of that suburb, right? So it's quite a lot of cyclical in nature as well, where I always feel that anything that is happening in the media is almost like you're looking in the reverse mirror because it's already happened. People are already talking about it because they can see it happening. It's not so much about going back to the fundamentals of property investing and the true predictors of property growth.
Yes, there is the ability. I always see analogies to the stock market. So the stock market is more sophisticated. Our machine learning models use stock market-like algorithms. And you could see this kind of thing as pump and dump or front running. So if potentially a BA could buy for their clients and then tout the suburb publicly. And that is not ethical, at the least. I don't know about legalities, but you'd be very careful about why are they pushing a particular suburb. So often it may be more innocent than that. So it may be simply the suburb is taking off. People are more comfortable with that. And my algos also like to see a little bit of a turnaround first. So but which one they pick is very important and very specific. But it can simply be that the narrative is being pushed for too long. That you're getting positive cash flow, or there's this undersupply. These things can be corrected.
But I mean, as a data scientist and as a fellow data scientist as well, right? I feel that, a lot of people who own platforms have a big responsibility as well. I was talking to John the other day, John Lindemann, and he's been a veteran in the data science space as well. And we were having a very interesting conversation where you're like, okay, you are a keynote speaker and you do go out and do a lot of keynote speaking. And Luke, it would happen to you as well, right? People would come to you and say, hey, Luke, tell me, what area are going to grow in next 6 months, 12 months, right? And, you make a single error, but you didn't know, but, you without looking at your analysis, someone has put you on the spot and you are basically out in a keynote in front of like 200 people or 1,000 people or in front of media, and you call out something. And the next thing you know, you go back and backtrack and realize, I was still finishing off my analysis, etc. And maybe there is a short turnaround, but this is not from a long-term perspective. It might be a mining town, or, there might be single dependent economy that is sitting there. So there's a lot more responsibility on people like us to be really, really careful as to what you say out and loud, because, people do get influenced by what we say and get influenced by, the decisions that they're making in their life.
Yeah. So I haven't done much market commentating. So I don't do a lot of like macroeconomic stuff. It's got to this much unaffordability, therefore this kind of person can't come in now. A lot of it I think makes sense and is, it sounds sensible. For me, I just defer to the data. So there are things that I don't quite know, and it's like, well, okay, this kind of makes sense to me, but I prefer people to trust the scientific rigor of the data and the analysis than Luke Metcalfe.
Rather than the person.
Yeah. So what I'm happy to tell you my view on what's going to happen to work from home or AI or whatever. But really what sets us apart, I think, is that we've just gone back so far and looked for what truly 100%. Resilient trends. So that's a lot of the time it's just like, they're saying stuff about affordability and all this. And I'm like, that sounds good, but I can't prove it personally. So
yes,
I'll just fall back to, or people will say, in a very specific, so if it's between this price range and it's this region because of this reason, and I'm like, that's interesting. It's just not
plausible.
It's plausible, and they might know, but I would just defer back to like more like, what are the laws? What are the rules, rather than this conversation about particular narratives around certain areas.
Definitely. And I completely resonate with what you're saying. Evidence-based investing is the key. I say this out loud all the time. Don't listen to me. I'm an idiot, right? Forget any data scientist, forget any property guru who's out there or claims to be a property prophet. Follow evidence-based investing and you can never go wrong, right? You can never, ever, make any mistake, if you follow it religiously and understand what the data trends are telling you.
12 months ago, my models were saying, go into Perth. Just go for Perth. Perth's awesome. And then people would come to me and say, come on, mate, it's Perth. You yourself say that mining towns are bad. And I'm like, emotionally, I'm sympathetic. Like, I understand. So like emotionally, I get it, but it's like, still I defer to the algorithm just because I know what its performance is. And it turned out to be 100% right. So Perth went crazy. And it's like, so it's like the models and the data are superior to me. Yeah. So, I can help explain things, and it's very important the way that we put it together and that we provide that rigor and we check it. Definitely. At the end of the day, the reports are actually superior to the pundit.
Yes, 100%. I completely agree. If I take a step back and we're talking about the criteria for determining growth, how important is the livability and the impact on the land value? Let's explore that a bit.
So land only has value because it has proximity to other things. So if you could get a block of land in the middle of the Nullarbor, like a quarter-acre block in the middle of the Nullarbor, I would have no value. Like, it'd probably cost more money for you to sell, to do the advertising, maybe have a novelty value to it, I don't know, but it basically have no value at all. So, and land value is really what you should be targeting. Another critique I have of the industry is that often the growth that they're talking about is a growth in the building, so renovation and building
material, inflation, basically.
Or luxury, so people are putting in McMansions and things. So often you'll have a growth 2 points in time, but actually you're talking about different housing stock each time. So each median price from CoreLogic made sense from the buyer at that time, but they're not comparable things. It's apple and oranges. Like, it was mostly
100%.
old shacks and 1970s homes that are fully depreciated 30 years ago, and now it's McMansions on top. Yeah. So land to asset ratios.
So you're comparing land value versus something which is, livable. There is an intrinsic value on the building in itself.
Yeah. So from the point of view of an investor, so we very much just, our target market is very specific. So it's just investors, the typical investor, they're looking to get in and buy a property and rent it out. They're not going to develop it. So just take from that point of view of the that kind of investor, they don't plan. They haven't budgeted for knocking the house down and making a mansion. Usually they just want to know what they can sell it for, assuming things don't change. So for that reason, we're very focused on same property growth. So among properties that weren't renovated, so the assumption of like, you hold it, you keep it, you might pay 1% in wear and tear to keep it going, but that's all you're going to do to it, because that in reality is what you're going to do as an investor. Land, coming back to the question. So land and proximity. So all of these things about lifestyle. So proximity to employment and proximity to CBD, amenity. This is the reason why you can actually have towns, smaller towns, they have more land supply, and then the price actually goes up. So it's a reversal of this usual demand and supply thing, because the additional supply naturally means that there can be more amenity. So it's like, okay, we've hit a critical mass where now we can support a chemist or another pub or a local employer. So so the amenity point of view is, in terms of like a valuation model, is very important.
Yeah. And when you talk about livability, for the viewers and listeners, can you explain a bit more about the livability side of things? What are the key things that you consider as part of the livability score and the HIP score? I know HIP score has been around for quite some time. Let's help people understand, what does that really mean?
Yeah. So a HIP score, that's like being inner city and progressive. So you're cool 21-year-old that wants to move out and be part of a scene. So that's like, it's beyond. It's not just young, but it's also, trendy and cool. Typically it's in a city, but you have pockets of it elsewhere, like at university campuses, for example. You can create this scene. So it's liveliness and a cosmopolitan kind of vibe. Then you have a lifestyle score, and that's more for the mainstream person. So that's like having access to things that ordinary people want on a weekly basis. So RSL, beach, pub, parks, shops, just regular kinds of stuff. Having a usual variety of shops for a mainstream person. You want a hairdresser and a tax agent and whatever else. Then you have your tranquility score, which is kind of the opposite of the HIP score. So it's about space and privacy. So getting away from it all. Green space, how green the area is another one. Then you've got convenience score. So that's about how long does it take to get to things that you need every day, like a place of work, a grocery shop, like to pick up some bread and milk or whatever. So that convenience is very much about, transportation links and such. And family score. So family score is NAPLAN performance.
School
it is
ratings.
Yeah, it is how well behaved the children are. So are your kids going to have a good life? Are they going to be around other good kids? And do they have access to good schools, amenities like playgrounds, and having similar demographics as well? So having other families in the area.
And where does the Housing Commission and the crime rates basically come in?
Oh, yes. So affluent score.
Affluent score, yes.
Yeah, so that's a very important one. Glad you remembered that. Yes, so that is a combination of wealth, income, and otherwise class, so socioeconomic area. So at the bottom, you've got welfare-dependent populations, and certain kinds of those inhibit capital growth, including public housing, which is related, not the same, but related. And then at the top, you've got your more affluent people that are sort of post-materialistic.
Yeah.
And they tend to inhibit capital growth.
Yeah.
So they're starting to think about things other than money. They're diverting their attention to, causes and the arts and things like that. And you tend to see a underperformance. And then in the middle on affluence, it's not simply that like it's just you go for the middle. There are certain kinds of gritty areas that are getting ahead. So certain kinds of motivated people that are successful in their lives, we're seeing in the data, and we'll be putting. So at the moment, affluence score gives you that, and that's well covered by Microburbs. And increasingly, we're going to be teasing apart this mid-level, because obviously the large middle, it's not like all of that goes up. There's certain characteristics there that lead to spectacular capital growth.
Yeah. And this is an important point, right? From a viewers and listeners perspective, that all of this data is available. I call them, the qualitative, that you're trying to quantitative to find the correlations to, what the price growth basically does at the other end, right? We're always continuously basically looking at where is different trends and how does, these crossover happens. The most important thing, and I read this comment somewhere, I think on a social media, where a person made a comment saying that crime data or affluency does not really matter, because, if it did matter, then, Townsville would not be going up in prices because, Townsville is such high on risk and the crime rate is so high. And they gave you a few examples, around, various different parts, Elizabeth and in Adelaide. What do you say? Like, affluence is such a big word, and you making a comment that, this does not get impacted.
Yeah. Yeah. So one point is be careful about anyone who talks just about a couple of examples over a couple of time periods, because, Australia is composed of hundreds of regions, and we have data going back to 1990. So there's a lot going on. So you can prove any point with real estate data. Like you could tell a story about anything if you pick certain markets and certain start and top. Like one universal thing that's bad is mining towns, right? Mining towns underperform pretty universally.
Yeah, but I can prove.
If you told me, Luke, I wouldn't do it ethically.
Yeah.
But if you told me, Luke, build me a case that mining towns are awesome, I could do it. So I could list you like 100 brilliant markets where mining towns absolutely boomed, and it's like it would be a slam dunk, like for someone new to the space. Yeah. So one point is that you really should be looking at all the markets all the time, which is very hard to do as an individual investor. And there's individual homes within it. So suburbs don't all move together. That makes it harder still.
Yeah.
But another point is that, yes, I would agree. It's not a simple matter of it being one continuum.
Yes.
And there are certain kinds of affluence that are good and certain kinds that are not. It's a nuanced picture. And then finally, I would also say, well, yeah, okay, let's say Townsville's a low socioeconomic area, but it's really, and it's got a certain value, but it's still, let's say it's gone down massively compared to the rest of far north Queensland. It's like, okay, but that's the biggest thing of all is mean reversion, yeah? So even if you might be saying, okay, it's been held back, that's like, but let's say it hasn't got more worse, right? Let's say it's about the same. And it's like, yeah, but it's still going to have a value.
Yeah.
Yeah. It's still a market
not a $0
that is
value.
going to correct.
Yeah.
We're in Australia, we have a chronically undersupplied market. So there's always demand. There's always going to be people who are thinking, look, we could move to Townsville because we might be able to get in finally in the market. Yeah?
Yes, correct.
They're renting in Port Douglas or something. And they're like, so there's always going to be people that are going to come in. So that any market in Australia has the potential to boom. I would never say that, all the dodgy places are just doomed forever, in the same way that you don't have this bifurcation where, the dodgy places go to zero. Like imagine like it just gets completely wiped out. I mean, if it ever did that, that would be, a lot of social things going on, a lot of very intense social problems among certain communities.
Agreed.
But that's just, the reality is in this undersupplied market, something would happen. Also, we have a lot of government intervention in Australia. So if there is a vulnerable community, so part of the reason that vulnerable communities can go up is that the government comes in and tries to fix it. So more money comes in.
Correct. Yeah.
There's a trend towards dissipating public housing, for example.
Yeah.
So not having it all in one place, but spread it out throughout the country. So that can easily happen. They can sell the public housing.
Yeah.
So yeah,
and that's a really good example. I think it's a perfect example, right? So I always say this to people that, when you talk about affluency, it's not a single denomination that would impact the growth, right? The growth has multiple layers of correlations happening. And it's almost like, there are different weightages to different things at different times, right? I would say the employment and the infrastructure, always would take the precedence, right? The government intervention would always change the markets first, no matter how the gentrification is happening at the bottom end, right? So it's always important to see all the drivers rather than making a blanket statement. And you're exactly right in saying that the affordability crisis that are going through, potentially there, right? When you talk about Townsville or you talk about Elizabeth and Adelaide, and again, I love that comment about you that I can prove anything by looking at a piece of data, right? And manipulating the data to tell whatever story I want you to tell, right? I can tell that, I'm a baby, if you go back 4,000, 5,000 years ago, what average age was like a 500 or 600 or 1,000 years old people, right? So I could be like, well, I'm a baby, right? And if you look at the data from that perspective, right? The important point is that when you think about the different things, like what's happening underlying in Townsville, right? There is massive government infrastructure. There's $30 billion worth of infrastructure that the government is committed to till 2050, especially from the Air Force and, all of those military sort of contracts that are in place for a very long time to build that area, purely from infrastructure perspective. You look at Elizabeth, the hospitals, the schools, and the government infrastructure coming through and dissipating the housing commission, that's playing a really, really big part in bringing Salisbury or the Playford Council quite up, right? So there is intentionally stuff that is happening there for it to basically respond or the markets to basically change. It's not that just because the crime rates are there and people are still buying, right? So it's always important to understand what the underlying factors are. It's not usually a single underlying factors that, drives this. Fundamentally, if you think about property market, and again, I don't know if you agree with this or not, right? If you buy fundamentally right, as you said, any parts of Australia, and if you're going in this for long term, like 10 years, 15 years, right? We know that the trends over the period of 10 to 15 years do not really, divert much, right? You still sit at like 6.5% growth, right? Whether you look at any market, you would not be like, and I'm really, really like generalizing this, right? I'm talking about, trends over a long-term period where, consistently annualized growth basically sits at 6.5%. They don't go like 10% every year for some of these major LDAs or city centers. So if you're really thinking about, okay, I want to set and forget and not do anything, if you buy the right product, like if you go for intrinsic land value closer to amenities, you could typically never go wrong, right?
There's definitely chronic undersupply in the Australian market.
Yeah.
So it's easier to build, it's politically easier to build amenity and infrastructure than it is to create supply. So people complaining about traffic, and over the long term, the property bears have had a terrible track record at predicting crashes. So what we've seen is very resilient growth. So despite, COVID and GFC and our current per capita GDP recession, we continue to see lots of growth. And so there's always markets that are going up. There's always opportunities. There's never been a market where everything's going down. And most markets perform averagely most of the time.
Yeah.
So if you imagine a distribution, there is a small number of markets that are doing really badly, and there's a small number of markets that are doing really well. And there's a lot that are just sort of coasting along, particularly if you broke it down into, say, regional versus city. So those are inversely correlated markets relative to the national average quite consistently. So I think there's a fair bit to that.
Yeah. And one question that I always have in my mind that no one talks about is more in relation to the predictors for poor growth. Like everyone talks about good growth, but no one talks about poor growth. Like what are the key lead indicators, or should I say ethnic predictors that would lead us to, okay, these are the areas that are to watch out for because there is poor growth coming through, or, the mean erosion that you have been talking about?
Yeah, so poor growth, mining towns overall.
Yes, of course.
That's a clear one. Just stay away. Like you can see mining towns do badly during a mining boom.
Yes.
I've seen it.
100%. Yeah.
So stay away from them. yeah, so there's definitely underclass.
What about, so let's take a pause there. What about towns that are not really mining towns, but they have dependence on the mining towns? Like, like there are towns which are in core, hardcore mines, right? And, of course, you stay away from them. What about the towns which are like 2 hours, 3 hours, or 5 hours away from the mining town, but the core dynamics of the population of those areas are basically those FIFO workers that are dependent on the mine anyway?
It's a good question. I have seen that you can have a town that is miners on one side of the town and not on the other, and both go down. So typically you're looking at, on an economy level, you're looking at what the ABS would call a SA3 kind of level, which is often similar size to an LGA, although that can break down in the outback when you can end up with these incredibly small LGAs. So yeah, that employment factor, in general, I would go for that kind of area. So, it doesn't matter if you buy a house, it doesn't matter that there's 1 million jobs 50 meters down the road.
Yes.
What matters is that that jobs are accessible.
Yes.
So
and consistent.
If you imagine your average person is is happy to go to like within a SA3. So like the idea of the 30-minute city. Yeah. So people are happy to drive 15 minutes to work. That's perfectly acceptable. Have some time on the radio, listening to the radio or whatever. So yeah, I think that would be my answer there. As you're getting more remote, that's where the really big capital growth can be achieved, but also it can be in the doldrums for a long time. And the further out you go, the more I'd be reliant on algorithms to be able to pick when they go up. It's a little bit like penny stocks.
Correct.
In the stock market.
Yes. Yeah. It's like you're following the trends, right? Basically, right? So, exactly right.
Looking at millions and millions of curves.
Yes.
So
correct.
It's like you got this town just ticking along for year after year after year, right?
Yeah.
And the rest of the region's gone up.
Yeah.
But it's quite hard. So it's easy for a human to go, that town's going to come back if they know about mean reversion, right? But it's much easier for an AI to know exactly when, because it's just seen so many curves in the past.
Yeah. Definitely. And I think you make a valid point, right? When you talk about employment, it's not so much about how far it is. It's more about the consistency of the employment and how long the employment is there for. I think one of the reasons that you stay away from mining towns is the volatility of the mines, right?
The reason I stay away is just the data.
Yes.
It just has bad growth.
Yes.
Right?
But I mean, the story
a lot
behind
of the time.
data.
So I will speculate on the why of these sort of things.
Yeah.
But at the end of the day, the why doesn't drive me.
Yes, of course.
So you could come up with an awesome story on like why mining is awesome, and you might be able to persuade me emotionally, but I'd still be like, I don't care. Like, it's just, there's so much evidence that they don't work.
Yeah.
That I'm just not, it's not going to change my mind.
And it's a very interesting and important point that you make, right? That a lot of people, they always try to understand the why behind the data. Sometimes there is no why. Sometimes, there is a why, but it's not evident enough. Like I was looking at this particular suburb, and so this is an interesting story, and this is going back almost 2 years ago. I was looking at this particular LGA somewhere in Queensland, and I saw a sudden spike in supply, and the demand started going up quite fast, like over a period of like 6 months, basically. And I was like, well, that's very interesting. And you could see like price fluctuating, going up quite fast. And well, the data was a clear indicator that, the growth is coming and it would keep coming, right? And so the geek inside me actually went there. I think it was somewhere in Queensland. I can't remember the name of the suburb, but, we were talking about Southeast Queensland, some area there. And I went there to check out and see as to what was happening here. There must be something that is happening here that is driving this. And interestingly, there was this one project that a particular private company was running. They were building a big solar farm or something along those lines. And what they were doing was they were acquiring a lot of residential real estate to put their people in there because it was a 3 or a 5 year project. And so they're like, instead of building something, we'll just come here and acquire ton of stuff. And because they killed all the supply, they took away all the supply, people who were actually looking for, they had to basically come in and start paying, slightly more and more and more every time. And it was just a short spur, right? But someone looking at the data from an outside, they'd be like, well, they can formulate a story and saying, oh, this is a growth cycle and it's going to continue for 10 years or 5 years or whatever that looks like, right? So sometimes, when you don't investigate, you don't know what the story behind that is. You can't just relate to just the data on its own. While the data is really, really powerful, it's also important to understand the trends on a long-term basis rather than just that, short window of opportunity.
Yeah. So sometimes the data that you have doesn't tell the story exactly, but it's a proxy for what's going on. So a great example of that is turnover rates. Yeah. So properties and streets that turn over quickly have less capital growth. Yeah. So for some reason, there's a house that keeps turning over. Yeah. We don't know why. We don't know that there's, radioactive rocks in the backyard, or maybe the next door neighbor turns the hose on you when you're outside. There's some big structural issue that no one ever wants to deal with. That could be particularly a concern for unit blocks. And it's like, we don't know until you see but you can just say, look, high turnover rate is bad news. It's like, just don't go for high turnover rate places unless there's a whole lot of other reasons why you would go for it.
Yes, no, 100%.
So there can be often some story behind it that the computer doesn't know. And then sometimes you can start with some data and it helps, and then you add more data and then it helps more. So coming back to that livability amenity thing. So people say, buyer's agents will drive to a town, doesn't have a train station, tick, suburb. How far is it from the train station? Tick. Okay, that fits my criteria, right? So logically, and you could see that suburbs with train stations tend to have higher value. Yeah. But I built a value model once and it didn't use proximity to train station. I was really surprised. It's like, why wouldn't you use that? Obviously that comes into it. And then I found what it was doing, because I throw in everything, right? I found what it was doing was it was looking at how people fill out the census.
Yeah.
Do they actually use the train to get to work?
Yeah, interesting.
So I was like, okay, that's a better measure
100%.
Because you can have train stations like here in Sydney. You got Clyde that barely anyone uses, and they closed it down, right? So that it's is it a useful train station? Is the better thing, right? So it's like as you keep on adding more data, you get ever more close approximation from the truth.
Correct.
But you still don't know everything, and you never will.
Yes. And when you talk about the poor predictors for growth, is there anything other than mining town? Can we add more?
So you've got your underclass in general, also remote Australia. So the more desolate kinds of places, they have less growth. So when you've got low humidity levels, that doesn't mean you can't make money. It's just overall, you're better off
staying away because of the volatility.
If that's all you had, then you're just going to have less capital growth. You just mentioned ethnic, so I will go there. Let's go there.
Yes, please, let's do that.
All right.
Yes.
Yeah, so migrants in general and migrant growth is a predictor of capital growth. So it's a good thing. And if you think about migrants, so they fit into this category of the gritty or hardworking people. But people go to a new country, they're typically the kind of person that works hard. This is not a race thing. So Aussies, for example, Anglo-Australians are known to be hardworking in London. Yeah. When we're migrants, we work hard as well. So it's just, so if you've got people that are looking to build their lives and start again, they come to a new place, they come with low status and they want to grow. So I would guess that's part of what's going on. Another thing is that migrants tend to prefer places that have other value anyway, yeah? So migrants tend to go for places that are convenient and good public transport links. They'll go into the big cities. They go into the major hubs. Your non-Western migrants are more comfortable with density. So Westerners, including new Western European migrants, they're more likely to go far away. So one interesting thing, I haven't done it lately, but I remember going to Google Images and searching for Australie, that's Australia in French, and Australien, which is Australia in German. And what you get is pictures of the outback. Yeah. So the least valuable real estate.
Yeah.
Whereas if you search for it in Arabic or Chinese, they show Sydney Harbour.
Yeah.
Yeah. The most valuable real estate. That says something about the mentality. So Westerners will tend to go for space and privacy, which is in much greater supply than this other stuff. So migrants in general are a positive thing. I would guess also what's happening is that migrants will often come in, particularly new migrants, they will come in because there are existing migrants of their type. So when they're starting out, so that could lead to there being more different kinds of buyer coming in. Yeah. So you might have an existing population of Anglos. Now you've got, Chinese coming in as well. It's like, okay, there are two markets. So the real estate agents are like, oh, this is awesome. I can pit the Chinese guy against the Anglo guy to get them to bid up the price. Whereas before it was only Anglos.
Yeah. And when you talk about migrants, right, and if you are taking a notch down and you're going deeper into the data, are we talking about like ethnic backgrounds that impacts the growth as well, or languages that plays a bigger part in, how, growth prediction look like?
I don't know. Would it be legal for me to?
Well, I mean,
look,
I mean, this is purely from a data perspective, right? And we're not trying to, racially discriminate people. We are just basically saying this is what data predicts, right? So, there's nothing wrong with that.
Yeah. So I mean, obviously different migrants come in to Australia with different socioeconomic status. Yeah. So you'll have refugees that come in as underclass. Yeah. So if they're doing that, and I would assume, I haven't done special analysis, but I would assume that just in general being welfare dependent, so certain types of welfare dependency could lead to less growth. And then you'll have other kinds of migrants. So if it's a, Mossman in Sydney, if Mossman becomes flavor of the month for Chinese that have $10 million to spend to park in another country, then that's only going to be good news.
Yeah.
So I think primarily it's about socioeconomic status.
Yes. Yeah.
Rather than race.
Yeah. I think you're using language as a proxy, right? So that's what it is. It's just easier to find the proxy rather than, finding the ethnic race, right? Yes, you can go down the census path and, find some of that detail information as well. But, while, we are doing our data analysis on all the other things that we've talked about, I think language plays a really, really big part. Every time you throw it into the correlation mix and see as to how, the data basically comes out. And so there must be something that's happening there, whether it be, the education background. And it comes back to the things that we've talked about before, the fluency, are the kids studying hard, are the parents hardworking, are they generally, well-to-do, they have better employments, etc. So it ultimately comes down to that as well. But
so language use. So if they're not using English at home, so on the one hand, you could see that as that they're definitely migrants and they're definitely part of they're working hard to build a new life. Maybe in some cases, it's also a sign that they're less engaged with society and they're more on their own. I couldn't speak to it. We don't look primarily at that, race or ethnicity in predicting. We don't look at all race and ethnicity in predicting capital growth.
What are some of the behavioral biases on the good data side of things, that can help us overcome, some of these things?
Yeah. So one big thing I find is confirmation bias. So I find investors that they get a couple of narratives and a couple of stories. I love going to that place, or that place is near my mother-in-law. It's kind of good, got a vibe about it. Maybe it's their own area. They've had some stories about how great it is. And people go very quickly to, okay, that's the suburb for me to just confirm. And if I go on, we have people like that, they just want to know about one suburb.
100%. Yeah.
And you get them through, it's like, okay, that's not actually that, you're not acting on very much information here. This is a few stories.
This is emotional decision making. Yeah. Basically, that's what I call it. Yeah.
Yeah. There's 15,000 suburbs in the country. There's a whole lot of suburbs like the suburb you're talking about. It's not as special as you think.
Yeah.
Have you really thought about is it overpriced relative to other suburbs like it? Yeah. Have you thought about the particular properties? Maybe it's not just one market anyway. You visiting and having a nice time is not the same as living there. And I mean, what really matters is that there's going to be lots of buyers coming in. Not so many buyers now, and lots of buyers when you come to sell. That's really what it comes down to, and that's quite a different story. So it's a big country. There are very many markets. So I find people, they narrow down way too quickly. So that a better approach is what are the fundamental laws of real estate investing?
100%.
What drives capital growth?
Yeah.
And then don't make it so much about, right now, today is different. I read some news, the RBA might do this, or, that it's good. This is evergreen content. This works anytime.
Yes.
So it's because of this trend that's going on. Everyone's talking about this, and it's like there's always trends. There's always narratives floating around.
Yeah,
but it is this fundamental machine of a market that keeps behaving the same way all the time. So do a really deep scan. That would be my strong advice. So avoid, this is confirmation bias, yeah? So people are just looking to confirm some thoughts that
whatever
they had.
the beliefs are.
Just do a bit of data ticking at the end. That's not as good as really like, okay, this is actually a complex problem. So investors underperform owner-occupiers is a really big, interesting stat by like 1.5%.
Yeah.
So you'd think people that are seeking capital growth wouldn't do as badly at it as owner-occupiers that are just looking for a nice place to live, yeah?
Yeah.
Where it's close to the things that they need. So
yeah,
investors should not feel too confident. They're overconfident. That's a massive thing.
And there's a herd mentality as well, right? When it comes to investor mindset, there is a massive herd mentality. You see, over a barbecue conversation, everyone is investing blah, and you just basically go out there and trust that,
absolutely.
that person. Yeah.
So you don't want many buyers right now.
Well. Yeah.
So you don't want everyone to be piling in. What you want is lots of buyers when you sell.
Correct.
Yes. No buyers now, lots of buyers later. But people have it the wrong way round.
Yes,
they're like,
correct.
oh, everyone's piling into this.
Yeah.
A lot of this, I think, plays into FOMO. So a lot of the reason people are investing in the first place is they have a mate and, hey, he gets paid 10 grand a year less than me, but he's got this great solid investment thing. He's sorted for retirement and I'm not. Now he's bought into there. I don't want to miss out on that. So humans can be easily manipulated by this idea of like something that someone else is going to get versus you. Whereas it's like, no, you want to actually like find the untrendy places. Like in the stock market, the good investors are the people who are going against the current thing. So there's all of this chatter. So, we've even, social media and the news, it's all filled with this stuff of like, what are narratives that we can put over at the moment?
100%.
And they're against actually, it's going to lead to an imbalance. These are the kinds of places that are going to go down, not up.
Yeah. No, definitely. And I think you make a lot of important points, right? I see these conscious biases all the time, right? When you talk about people motivated by different things when they're basically buying these properties. I'm always of that opinion that focus on owner-occupier markets, because owner-occupier markets is driven by livability, right? And so if you're buying in an area where there's a lot of owner-occupier fighting over a property, and you end up even slightly overpaying, but end up buying that property, know that, these owner-occupiers would still be there if you're buying it fundamentally right? When you're going to sell this property, because that interest in this place, it would always be relevant, right? Of course, minusing the mining towns, etc., all of those things. So it makes a lot more sense that you basically follow the basic mentality, as you say, the laws of real estate, right? That's what it comes down to as well. It's very, very important.
Yeah. Related to this is availability bias.
Yes.
So people they'll have the most recent data in their heads rather than long-term laws. So they've got a few things going on. You'll see a whole lot of people doing very well on YouTube where they start with a scare video, a scare thumbnail. The property market is about to collapse. What are you going to do? Then you get 5 minutes into the video. It's like, no, that's all fine. And you learn this is the same video over and over again.
A lot of people basically follow others based on what the perception is. Like, so, I want to be like that person because he drives an expensive car and has like 10 properties. They don't know what their LVRs are, what their properties have done. It might be like 2 properties that has performed and the 8 that hasn't performed, right? So it always is about falling back to the same biases, right? So yeah, it's quite interesting and, yeah.
Yeah, you just want the best return on investment.
Yes.
At the end of the day, obviously, if you're getting good return on investment, you can scale it
100%.
up. You can get more equity or you can flip properties, get more money in the bank and get more.
Yeah. Flipping and development is completely, again, a completely different world, and the data works in a very different way in that space too. And so, I think that's a conversation for maybe another podcast so you can, unpack and talk a bit about that. Wrapping this up and bringing it to the close, Luke, where can people find you?
Microburbs.com.au. Check us out. We're on all the usual socials as well. But yeah, come to Microburbs. I'm always happy to talk to investors. So you can make a meeting with me if you're not sure to buy. I love to hear people's stories. And yeah,
amazing.
Facebook, Twitter, YouTube.
Awesome. Well,
Yeah, we'll be putting out lots more video content soon.
Definitely.
So,
and look,
got to get your face out there.
Thank you very much for coming on the show today. I think this was great. This is, first of the many, I'm hoping. So, thank you for providing us the opportunity. For viewers and listeners, if you have any questions, comments for any of the content or about this podcast, please reach us out. You can find us on our socials at helpmebuy.com.au. Thank you for listening to us today. Take care, be kind, stay safe, keep investing. This is Luke and Moss checking out videos.
Thank you very much.